Now that we have concluded that Capitec is a great business, let's see how it performs against its closest competitors. Capitec competes with the likes of Discovery Bank, Standard Bank, Absa, Nedbank, FNB, TymeBank, Investec, and many others. In this video, we are going to compare the performance of Capitec versus Standard Bank, Absa, and Nedbank. Let's start comparing Capitec with Standard Bank. Beginning with revenue, we can see that Standard Bank, in terms of revenue, is light years ahead of Capitec. For example, in 2021, we see that Standard Bank's revenue is 218 billion rands versus 23 billion rands of Capitec. And in 2022, we have 224 billion rands of revenue for Standard Bank compared to 27 billion rands of Capitec. So you can see that in terms of revenue, Standard Bank is light years ahead. And in terms of net income, in 2021, Standard Bank had 25 billion rands versus 4 billion rands of Capitec. And then in 2022, Standard Bank had 29 billion rands versus 9 billion rands of Capitec. So in terms of net income as well, Standard Bank is ahead. Looking at return on equity, we see that Capitec is ahead of Standard Bank. In 2021, ROE was 17% for Capitec and 13% for Standard Bank, and 26% in 2022 for Capitec and 15% in 2022 for Standard Bank. So in terms of ROE, Capitec is ahead, slightly so. And then in terms of net profit margin, Capitec is also ahead of Standard Bank. In 2021, net profit margin was 29% for Capitec versus Standard Bank's 12%. And in 2022, net profit margin for Capitec was 36% versus Standard Bank's 26%. So what does this mean? It means although Standard Bank makes a lot of money versus Capitec, Capitec is a more efficient business. All right. And the most important thing to note also is not only is Capitec a more efficient business because it has a better ROE and then a better net profit margin, it is growing at 17% versus Standard Bank's growth rate of 7%. So the growth rate of Capitec is over twice as much as that of Standard Bank. So if I put my money on Capitec versus Standard Bank, not only will it be used efficiently, but it will be growing at a rate that is twice as fast than if I put my money on Standard Bank. So I get more value for my money investing in Capitec than with Standard Bank at the moment. Hope that is clear to everybody. Now moving on to Absa. We see that Absa, their revenue is also greater than that of Capitec both in 2021 and 2022, and also their net income for Absa is also higher than the net income of Capitec, both in 2021 and 2022. So they make more money than Capitec. But if you look at the return on equity, you can see that Capitec is ahead. They have a higher return on equity, both in 2021 and in 2022 than with Absa. And the net profit margin also is superior. Capitec's net profit margin is superior than that of Absa both in 2021 and in 2022. Absa is also growing at a rate of 7.6 versus the growth rate of 17% for Capitec. So the narrative here is still the same. Absa makes more money, it generates more revenue, more income, but Capitec is more efficient, is a more efficient business, and it's growing twice as fast as Absa. So I will get more value for my money investing in Capitec than with Absa, as I explained in more detail with the Standard Bank case. Moving on to Nedbank, still the same. Nedbank generates more revenue, both in 2021 and 2022. They also generate more net income, both in 2021 and in 2022. So Nedbank also makes more money than Capitec. But again, Capitec has a higher ROE in 2021 and in 2020 and in 2022 than Nedbank. Capitec's net profit margin is also higher than that of Nedbank, both in 2021 and in 2022. So also, even though Nedbank generates more revenue, they generate more money, Capitec is more efficient in turning that revenue into profits, and is also growing at a rate that is twice as fast than Nedbank. So my money will be used more efficiently and will grow twice as fast if it's with Capitec than if it is with Nedbank. So recap: compared with Standard Bank, compared with Absa, compared with Nedbank, there's more value investing my money with Capitec, and my money grows faster. It is used more efficiently and it grows faster with Capitec than with either Nedbank or Standard Bank or Absa. Comparing the share price performance of Capitec, Standard Bank, and Absa, the same narrative remains. Capitec share price far outperforms that of Standard Bank, which is the green line, and that of Absa. I mean, the gap is huge. The share price performance for Capitec is 800% higher than that of Standard Bank and of Absa. That's huge. It's a no-brainer. My money is with Capitec, definitely. Now, we've seen that Capitec is a great business and it does well against competition. Does it mean now that I can just go and buy it at any share price? No. Even though Capitec is a great business, if I buy it at the wrong price, that great business will become a bad investment. That's why I always buy shares of great companies when they are undervalued, when they are below their intrinsic value. All right. So before I start buying shares, I need to know what the intrinsic value of Capitec is. And to determine the intrinsic value of a bank, I use the price to book ratio. Now, I'm not going to explain to you today in this video what the price to book ratio is and how the method goes. If you want to learn the fundamentals of investing, you're going to have to enroll in my training, in my training course, so that you know the fundamentals and the basics of what I'm talking about here. So what I do is I use the price to book ratio to value banks. I get the historical trend of the price to book ratio of Capitec. I get the maximum price to book ratio and the minimum price to book ratio. And from there, I get the median price to book ratio, which I use in my equation. So for Capitec, the maximum, the highest price to book ratio we've ever had is 8.4, and the minimum price to book ratio is 2.1. And therefore, the average of this maximum and minimum is 5.3. So the median, the average price to book ratio of Capitec since its inception is 5.3. Looking at this equation, price to book ratio, it is equals to the share price divided by the book value per share. By rearranging this equation, I am able to get the share price is equals to price to book ratio multiplied by the book value per share. The book value per share I got on Guru Focus website, which is equal to 308.05 rands, this one here. So I then take the price to book ratio, which is 5.3, I multiply it by the book value per share, which is 308.05, and then I get my intrinsic value of Capitec, which is 1,633 rands per share. So that's the intrinsic value, that's the fair value of the business, the true value of the business, according to my evaluation. And as of 10th of March 2023, the current price of Capitec share is 1,689. So you can see that the current price is close to the intrinsic value of 1,633. It's slightly overvalued. So when is it the right time to buy? Now that we know what the intrinsic value of the business is, we can then determine at what levels we want to start buying. Now, as an investor, I never buy all at once. I buy in stages. I get certain support buy points which coincide to certain support levels, and I average down. As the share price goes down, I buy in stages. Now, I'm not going to go in detail in this video how I come about the buy points. We're just going to have to, again, take my investing course in order to learn all of this. So to give you an example, for Capitec, I have 3 buy levels which coincide with certain support levels. My first buy level or point is at 1,529. My second buy level is at 1,300. My third buy level is at 1,077. Right. I think this is about 6% discount, 20% discount, etc. So I have these 3 buy levels. So when the share price goes down to my and reaches my first buy level, let's say I have 30,000 rands to invest in Capitec, and the share price has just reached my first buy level. What do? I take 10,000 rands, I buy 10,000 rands worth of Capitec shares. This level is about 6% discount. If the share price goes down even lower to and reaches my second buy level, I again take 10,000 rands and I buy 10,000 rands worth of shares. This coincides to a 20% discount to the 1,633 intrinsic value. And should the share price go down even lower and reaches my third and last buy level, I will take the remaining 10,000 rands and buy shares. And this coincides to 34% discount. I never buy at a premium. All right. So this is how I will do it. This is how I buy shares. I dollar cost average down. I don't buy all at one point. I buy in stages. And it is interesting to see that the analysts at Guru Focus, they value Capitec at 2,000 rands per share. So they are more optimistic. I'm more conservative. And that is part of being an investor. You can research and find out what other analysts are thinking, what other investors are thinking. But at the end of the day, you make your own decision and you live by the consequences of your decision. All right, I hope it is clear to everybody. All right. Capitec is a great business. It's doing well against its competition. But with investing, there's always a risk. It may be low because you're investing in a great company, but there is always a risk. And for Capitec, I see two threats with regards to investing and buying shares of Capitec. The first one is that banks are cyclical in nature. They perform well when the economy is booming, but are hit hard during economic downturns, recessions. Banks are also prone to loan defaults during recessions as individuals and businesses struggle. But for me, this is a low risk because Capitec is well capitalized and will be able to deal with such challenges. The second threat is price competition. It is the competitive nature, it is the price competitive nature of the banking business. Financial services is a highly price competitive sector, meaning Capitec has to keep offering products and services at lower prices than the competition to remain successful. Capitec has to keep innovating, especially technologically, to remain a step ahead, which means spending large sums of money annually. And should Capitec stop spending the money that they're spending? Should they stop innovating, stop investing in new technologies, stop coming up with new products and services? They'll get overtaken by the competition and they will move from being a great company to being a very bad company, and you may lose money. So these are the two threats. They are low, but they are threats nevertheless. And it is always good to know what you are getting yourself into. Well, that concludes our deep dive research on Capitec Bank. I hope you enjoyed it and you were informed. Now, bear in mind, just because I'm planning to buy shares of Capitec, it doesn't mean that you must buy shares of Capitec. What is good for me may not necessarily be good for you. You have to make your own decisions. You have to do your own analysis, do your own due diligence, and make your own decisions and live by the consequences of your decisions. That is very important to know as an investor. You can use my report as a guideline for information and education in order to get more informed as you make your own decisions. And if you say you want to receive these reports on a monthly basis, you can join my Ibhuku Lomnotho playbook. In this playbook, you will receive a monthly market analysis of the performance of the JSE and US stock exchanges. And you will receive 2 deep dive reports of great companies that you can invest in. You can take those reports, go through them, and then make a decision whether you want to invest in those companies or not. The choice is yours. I do all the work for you. I put in all the hours for you, put in a detailed and thorough report of the top 1% companies that you can invest in, and then you make your own decision. If you want more information on how you can subscribe to this monthly subscription program, you can email me at mdleche2020@gmail.com. Happy investing, and I will see you on the next video.